Hello, everyone. Welcome back to the Daily Gold podcast. I am going to be starting a new series on Mondays called Macro Mondays, and it will either be an interview on the Daily Gold podcast or I will do a solo video. And so the focus of Macro Mondays will obviously be macro. And with me here today is Gary Tanashian. He's the editor and publisher of Notes from the Rabbit Hole. He's been with us several times. And when it comes to understanding the real fundamental drivers of the gold stocks and the macro that create those drivers or signal those drivers, nobody understands this better than Gary. So, Gary, thank you so much for coming on. And I know you've been writing about and publishing in your newsletter about how it looks like the macro and the fundamentals for gold stocks, they're really starting to line up. And you say for the first time in like 20 years. So could you just give us an introduction on that?
Sure. I believe that's what is in play now because I believe that the 20 something year string of what I call inflation on demand by monetary and fiscal policymakers, at every sign of a deflationary liquidation, they were given license by the bond market to inflate. It's sounds ironic, but it makes a lot of sense. A deflationary market or market signaling prompts inflationary policy, and we all know or should know that inflation doesn't just come about, because people want to raise prices. It comes about from money printing, ramping money supplies, more currency units chasing finite assets, all of that. So what happened with interest rates in 2022 was a profound change from a long-term trend standpoint. And that's why I believe the bubble in policymaking, unfettered, unrestrained policymaking, has a good chance to have ended in 2022. The Fed will try to inflate, they'll roll over, they'll be dovish, but I don't think they have nearly the bullets in their chamber this time, or arrows in their quiver, whatever you want to call it. I don't believe they have the ammo now to completely manage the financial system as they have in the past. So I think that a lot of cyclical assets, first and foremost, primarily stocks, are square in the sights of this negative turn. They've benefited from inflation consistently during this bubble phase of the last couple decades. So I think we've changed, and I think that it's the inability that I believe will be the case coming up of policymakers to completely control the markets and, to an extent, the economy's reaction to their policy. I think that has brought us to a whole new macro, and it's exciting to finally be able to talk about gold, and especially gold stocks, and to be bullish for fundamental reasons rather than quick reactions out of like coming out of the 2008 disaster, the 2020 disaster. Those were quick shots up where gold mining and the precious metals led the macro out of the abyss and then would go into inconveniently long bear phases after that, while all the positively correlated stuff, the happy stuff, kept on rising. Well, that's over.
Okay, so drilling down, let's get into the fundamental drivers for gold stocks because I love the way you explain it. You talk about the positively correlated things, and so it it seems. I mean, there's a lot of nuance involved, as you know, and
Mm.
yeah, why don't you get into that for us about how um, when you do have an economic contraction or you have problems in the economy and the positively correlated things then come under selling pressure. The cost inputs for miners, they aren't rising, but then at the same time, the market is sensing, the Fed has to act or they have to ease, be it fiscal or monetary. Is that a good explanation that I'm putting forth here, or do you want to share a better one?
Well, no, I mean, it's a good explanation, but what I look at is the results of the dynamics in play at any given time. So the result is going to be where gold, which I see as a big hunk of metal, a pretty metal, a hunk of value, a stationary unit sitting there, watching itself get marked up and marked down, depending on confidence in the system. It's anti the system. So if you see gold, as I do, as just being a lump of value doing nothing, as confidence declines, that doing nothingness is going to get marked up in the public mindset. If we're in a bubble like we've been for so much of the last 20 years, it's going to be marked down, or it's going to underperform as it has. And if they're running out of tricks to maintain this thing, I believe that this stable marker of value is going to continue to be marked up related to the things that benefited from the intense bubble we've had. So, I think gold miners have, well, I know gold miners have leveraged that to the downside. Gold standing in the macro, they have leveraged to the downside. It's reflected in the HUI gold ratio, and then HUI ratios obviously versus all the bubble stuff as well. HUI or GDX or whatever gold, gold stock marker you want to tie it to. It just made a lot of sense that gold stocks sucked over that 20 years, way more often than they provided positive excitement. And now it makes sense that that's changing. If we're right that stable gold is going to be revalued against other assets for its stability in a difficult time.
Gary, what do you see? Because I know you don't like to look forward and make proclamations or predictions, but in theory, what is going to be the best driver of gold? I mean, fundamentally, you think over the next couple of economic quarters, like what do you think will be best for gold in real terms? Is it the Fed starting to cut rates, or is it the market sensing that the economy is about to go into a recession, or is it something else?
Well, I don't really obsess on what's going to drive gold, or the prospect of even gold being driven. I do have technical targets over $3,000 an ounce because I'm a chart guy as well, and those measurements have been there for years now. Really, I've been watching that since 2019 when it broke into its new bull cycle of the long term, since 2001, secular bull market that's been ongoing in nominal gold prices. But I am not necessarily thinking that the gold price is going to rocket to anywhere, especially if the environment is deflationary, like I think it's going to be. I mean, there's going to be some pressure, and it will rocket, in my opinion, and in my experience, it will scream higher against the S&P 500 and other stock indexes, against many commodities, which it's already, I don't know if you saw this weekend's edition of NFTRH, but
I
it's
did.
already broken out versus the commodity indexes versus copper, oil, all that stuff, those are positive building blocks of economies. So they're anti what gold is in its counter-cyclical suit. So the leverage comes from gold's relation to all those assets and stock markets, but also the mindset, the confidence or lack thereof in the public. You know, they want that stability, especially if they're going to see policymakers panicking, politicians, you know, demanding new inflation and currency corroding monetary policy. It's chaos out there. I don't really manage the wars and some of the real geopolitical stuff going on out there, but it doesn't help either. And if the average person is going to come to value stability, they will value gold over most of this stuff. And then these companies that dig it out of the ground should have more of a tailwind than they've had over the last 2 decades.
Now let's get into the bigger macro. I don't want to put words in your mouth or give away what you're writing about, but I think with respect to the stock market, you said at this point, you're not sure. It looks like there could be a couple scenarios where, the sell-off that we've seen, it might be the start of a bear market, or, maybe we get one more leg higher and then there's the start of the bear market. Could you add some color to that and what, might be driving either of those scenarios over the coming months?
Well, our view has been consistently now for all of 2024, even back into 23, that we're looking for to or through the election. It just made too much sense. And then when we see the government hiring every month, which has been compared to historical, or at least in my experiences, historical records, it has been off the charts. They're obviously trying to maintain power. That would be the Democratic administration. And, payrolls is limping along, inflation is fading. There is a Goldilocks consideration out there in the interim as we transition to a counter-cyclical economy, a bad economy. So I think that everything's aligning well, and we've been looking for Q4, the current correction. It could prove to have been the first leg of the bear market, but I'm not at all ready to pronounce that or, go with that, because the trends are up in the markets. This was a much needed correction, or still is, I guess. We're still within the parameters of the correction that started a couple of weeks ago. But I am more than open to a new high in the stock market and the bubble not having been completely burst yet. And I am looking for anywhere from Q4 2024 into the first half of 2025. When this thing starts unwinding, I don't think it's going to stop. And I don't think the usual policymakers are going to stop it in any effective manner. At best, although I don't know why someone would associate the word best with stagflation, but at best, they'll inflate and we're going to have a stagflationary economy. At worst, they're going to be ineffective, and the bond market is going to take care of all that debt that's been built up to support the economy.
Yeah, shooting blanks, so to speak.
I would think so.
Okay, yeah, let me follow up on that. I think that's really important because I know a few other people have mentioned this. Bill Fleckenstein, who I interviewed several months ago. I mean, obviously, economics and the future, very difficult to predict, but I think you and I and most people would agree who are looking at this, the economy's slowing, recession is more likely than not, and the Fed, they're definitely going to ease. The market's already priced it in. But then, yes, it comes to what you were saying, what happens after that? Like, because of all, the new factors now, that this is not going to play out as it has in the past, where the Fed can reinflate and you just get a normal economic cycle for 4, 5, 7 years. What you're saying is that you could get, after that reflation, you could get stagflation very quickly. And so the key signal of that would be the bond market. And so should we be watching the long-term bond yields to see if after the Fed cuts rates, the curve really steepens, aggressively? I mean, is that the real negative stagflationary signal, at least as far as looking at next
Well, it
year?
could be the negative stagflationary signal or deflationary signal. Right now the curve is steepening or making its move to steepen. It hasn't uninverted yet, but it is rising, and it's rising under deflationary pressure as risk went off in the markets, and people piled into short-term bonds versus long-term bonds, although both are nominally rising and yields dropping. And I think in the interim that will continue. So the deflationary phase is probably interim to whatever is going to happen. This disinflationary phase is interim to what's going to happen when the curve really starts to steepen after it uninverts and keeps going. It'll be deflationary pressure with money rushing risk off into the shortest term instruments as opposed to the longer term instruments. That would drive the yield curve up, even though yields were declining. Or, depending on what they do with the policy and this $34 trillion debt bag they've got out there, I can't control what they will attempt. And I don't know if the bond market can control it either, but it can react to it. And, if yields are rising at that time and nominal long-term yields are rising harder than short-term yields, then we're looking at some kind of inflation. And I can't imagine it's going to be even as, I don't want to say pleasant, but it will be worse than the one we just had, which was not very pleasant either, but it may have just been an appetizer for the next inflation phase. Either way, I think it benefits gold. And insofar as it erodes the economy, I think it will benefit gold versus the cyclical markets that we've been talking about as well, stocks, commodities, the things of economic growth and prosperity and whatnot. We're not talking about a happy situation, I don't believe.
Right. Yeah. But before getting more into gold, and I do want to ask you about silver, but I guess one last thing. So you see, I mean, deflationary or disinflationary first, and then there's obviously the risk that leads to, more inflation and stagflation. So it seems that the deflationary or disinflationary period to come, the Fed will see that, and the Treasury as well, and they will think, okay, oh, this is, yields are so low. I mean, this is great. We can just pump money in, but they could keep doing that, and then at some point it could, the yields could blow out, and then you get the other side of it, like the stagflationary side. Is that, again? I'm not trying to pinpoint you on anything, but is that just one possible scenario?
Yeah, sure. And you've probably seen the picture I have of the long bonds yield, the continuum, and that trend break in 2022. And the lever to prompt them, it can drop a long way, and it is dropping now. It's dropped a portion of the way that I expect so far. And it's going to feel deflationary, and it's going to feel like policymakers have to jump in and liquefy the markets however they can. They'd start with rolling over on the Fed funds rate, but God knows what other manipulations they can do if they go back to the same QE type bag of tricks, MMT, QE, whatever other abbreviations we want to put on it. But the point of it will be, the thing to watch for is that would happen at, I believe it was somewhere around 3% on the long bond, whereas last time we were down in the ones. And those days are over, unless the chart is lying and the trend is lying. But now the moving averages are turning up. It's a new macro. We have to interpret what it is. And my first interpretation on that is wave bye-bye to the age of declining interest rates on the long term, on the long bond. still open to interpretation how that's going to play out. But I believe stagflation or an out and out deflationary disaster. Something has changed. They remote managed this thing to the frustration of many who knew that something was wrong over those 20 years. But they happily managed it, and the public believes you always, home prices are always going to go up. The stock market always comes back. It's just a real happy situation. Shut your brain off and just let it work for you. And it's not going to this time, in my opinion, based on indications. So I don't start, railing about the bearish stuff and the negative, scary, doomy stuff. I learned a long time ago to really put a lid on that and go by what I see. And this time I'm going by what I see, and it's not as pleasant a story for the average person.
Okay, well, let's. It's a good transition. Let's talk about something more pleasant, which would be gold and silver in a in a real bull market, as I like to say. Yeah, before we get to silver, gold, Gary, because we see gold breaking out today. I mean, it looks to me like it's breaking out again. Yet, gold in the last couple weeks, it's really outperformed the rest of the sector, which is never really a good thing. So, I guess in the short to medium term, what are your views on gold? Do you have any upside targets you're looking at or support levels?
Well, first of all, the HUI gold ratio has stayed in its uptrend from, when did we bottom? I can't remember, but several months ago. The intermediate uptrend in the HUI and GDX gold ratios are still intact and were intact up until this morning. I assume they are as well now. I think the gold stocks are up pretty well. Gold itself is nesting up there on the 50-day moving average and held a pattern and held just fine in all the recent market volatility. Silver got hammered. I noticed today silver's up well, and but it's still within like many other commodities and markets, stock markets, it's still within the confines of a potential very short-term downturn or downtrend. Hasn't put a real hard test on the 26 area, which I thought it might do. And so silver still looks vulnerable in the short term, although it's hard to say that on a nice day like today. I own SLV, so I'm talking against my book at the moment when I'm saying that there is little vulnerability in the short term, just as there is for stocks and commodities. Gold is its own animal. I believe it's seeking out the value play that we talked about earlier. I just believe that as the tension mounts, people's first impulse, or more people's first impulse, along with central banks and sovereign nations and whatnot, are to add gold. So it's got a bid under it. Silver's really the one to watch for the speculative end of it, and as a trigger when it will take over for gold and start to ramp up. Just hasn't broken out yet from the short-term downtrend, although it's up nicely on the bounce. So yeah, I see silver as a guide, sort of the wild man in the tempest in the teapot kind of thing for the sector, where when it gets a move on, get out of the way, and the whole thing, the cacophony gets loud, and off we go. It's party time. But everything seems fine to me right now, if you can bear the idea that possibly the short-term bottom grind isn't complete yet. Although I noticed on GDX, it looks nice today. It's breaking upward. I think it broke above the 50-day average, which I wanted to see. I'm not sure. But I looked at the chart. I said, I don't think I want to do any selling today. I'd rather deal with the volatility than try to think I can sell an up day and have it keep on going potentially. So I think things are ship shape in general. even though we're not clearly having bottomed yet in the short-term rally. And the other thing going on with the gold stocks and the precious metals is that they're not unique on the macro yet. They're generally in a pullback here, as stocks are generally in a pullback. They're generally recovering as stocks are still levitating in their little V bounce, which could also be bear flags and subject to some new grinding and downside testing from last week. We uncovered some technical indications that at least allow for some short-term volatility in stocks. And I don't know that the gold sector is ready to go against that if some bottom testing or some news comes out that sparks the markets negatively. But I don't want to test that by selling out and thinking I can time the sector, because I'm bullish on it, and I'm bullish on it for a long while with increasingly positive macro signals. So I think I'll just, may take a profit here and there, but look to add to positions generally.
Yeah, let me press you on the technical targets. So gold, I think you had one of 2450. I had a target of 2500. Do you have a near term or 3 or 6 month target, or what do you see on your charts as the next objective if gold goes
Really,
above 2500?
yeah, I haven't. As you know, we've been in the middle of some real upheaval with moving, and as you can see, my well-appointed walls here with nothing
A
on
great,
them.
oh, it's a great background.
Yeah, yeah. So we're still, coming down from that, and I haven't really watched too closely, especially the micromanaging gold's price. But yeah, it hit the 2450, which was our first target, like going back months ago, months and months. I think when it broke out to a new high, that was the next target based on the pattern. Um, we've been talking about a larger pattern target of 3,000 plus. And that could, depending on how things fall, and what kind of emotions get into the markets and whatnot, I believe we've pulled in the 3,000 target sooner rather than later. I don't know what sooner is. I had been thinking 2 to 3 years, but I don't think it's going to take nearly that long now. And basically anywhere in between. We're only $500 an ounce from that. I'm not sure what the gold price is doing today, but that, I think in this environment, and considering that gold's been consolidating here against a troublesome macro backdrop on the broad markets, there could be the thrust building up to get up close to that target. I didn't have any targets between 2450 and 3000. So to me, it's the 3000 express or bust. But either way, it's bullish, and it's bullish on all time frames, daily, weekly, monthly, you name it. It's a good bull market in that monetary anchor.
And for silver, do you still have that $35 target?
Oh, yeah. Yeah, I just have wanted to see support get tested, which it has. It just hasn't gotten tested hard. But this could be the new leg up. Either way, that's just the next target. Depends on, again, what emotions get into the market and whatnot. And who knows where it could go. It could launch up to the old 50, the famous $50 mark on silver, could go beyond. Either way, it's been incredibly restrained lately, and it's in a bullish, well, gold is bullish on its trends and just flat out bullish on its charts. Silver is bullish in its potential and in its pattern and its proximity to very clear long-term support. And it'll depend on, what kind of bugs get into the process here, gold bugs or silver bugs or speculators or investors. It'll depend on how scary I think the macro backdrop gets, but silver has the potential to really put on a move. And I want to add to the SLV position over time in preparation for that.
Oh, I like the sound of that. That sounds good. Gary, before I let you go, is there anything else you want to mention that we haven't covered yet?
Well, there probably is, but again, as I said, I've been we sold a house, spent 2.5 weeks living like hobos, squatting in someone else's condo. And, I've just had so much going on. So I'm not the market watcher I normally am. I'm better this week. I'll be better next week. Hopefully back to normal very soon. But no, I think, my main interest is the gold stock sector. I want to watch it become unique in the macro. I want to watch for potential hazards for it if it's tied too closely to the broad markets, because I do believe a bear market is on its way. And so there will be the potential for a downturn in the gold stocks before the meat of the bull market resumes. That's possible. The one last thing I want to mention, we have this chart that measures gold versus RINF, the inflation expectations ETF, which is a rough tool to show us how gold is doing versus the inflation markets or inflation hysteria, inflation expectations. And what I really like seeing is how HUI is aping that ratio. So it's leveraging a disinflationary environment, because when gold is rising versus the things of inflation, like commodities or that ratio, it's not telling us an inflationary story. It's telling us the opposite. And the gold mining operations generally will benefit from the opposite. They sure haven't benefited from all the inflation we've had in the last 20 years, consistently anyway. So that's, macro could change sooner rather than later, and it's definitely in process. And gold stocks are doing something they haven't done consistently at all, if at all, and that is following a disinflationary path, which is, I believe, the path that the macro is on. So it's all systems go. There's going to be volatility, ups, downs, thrills, spills, but I think we're on track nicely.
Gary, before I let you go, could you please tell our listeners how they can follow you on Twitter? Also, where they can go to subscribe to your great newsletter.
Well, the handle is NFTRH GT. I'm not sure if it matters, but it's capital NFTRH, lowercase GT. And the website is nftrh.com. Hopefully now I'll be able to, I don't know if you hear the sounds of the city out there. I moved from the country right to a city environment. I love it. NFTRH.com. That just made me lose my train of thought. But what I was saying is there has been a lack of public analysis, public articles, because I've just been flat out. And so I'm getting back on top of that, and people can come to the website and they can get an idea of how I operate and how we operate, and an idea of the general details of where I think we're going. And from there, the NFTRH service obviously takes it to the next level, and we really hone in and make sure we're on the right side at all times. So if people want to take a look, I would very much appreciate that.
Well, I'm a happy subscriber, and everybody out there, if you really are interested in macro, but macro expressed in the markets, which for me, that's the best way to follow it. Nobody does it better than Gary. So go to his website, subscribe to his newsletter. Gary, thanks so much for coming on. I know I was pestering you about doing this for a couple weeks, but glad we are able to do it today on the first episode of Macro Mondays. Thanks so much, and look forward to talking to you again over the coming months to see how this thing unfolds.
You got it. Thank you, Jordan. I appreciate it as always.